Well, good afternoon. I'm here in the office of Jeff Fagnon, and Jeff is a former partner of Atlas Ventures, now known as, appropriately enough, FKA
For now,
for now.
placeholder.
And he's a very prominent and experienced investor, largely with early stage companies.
All with early stage, yes.
And
Some are large now, but they started early.
But some are ones that you're probably familiar with. AngelList, which is the really the preeminent crowdfunding platform. DraftKings, the daily fantasy baseball league, which we'll get into that a little bit more
And
later.
football and basketball and golf and Premier League. Don't stop with baseball.
Always promoting. So Jeff, just how many business plans do you look at a year?
We did an analysis that we look at about 5,000 business plans a year. And I use the word plan loosely, but 5,000 things come in that we at least filter. At the end of the day, we probably take 200 seriously, and we invest in 20.
And how many do you actually read?
If you send me a full business plan, I guarantee I won't read it. I've never funded a company yet that has a business plan, but I read slide decks of 10 to 15 slides religiously, and that's probably the best way to get a venture capital attention is here's a slide deck. It's a working copy for the company. It's a working document. It's a living document. Here's what we do.
And in that 5 to 10 slides, what are you looking for?
I think a lot of it is, founders and the team, their domain depth, why they care about this problem, the problem that they're solving, why it's a hard problem, why they're kind of exceptionally orchestrated to solve that problem, and then just a little bit around tech and product. Here at FKA, we're product geeks and we're product led, especially in the earliest of stages. So we kind of trend to that. Don't give me 5-year financials. I don't care. A year financials are great. Don't show me a hockey stick. I won't believe it anyway. What I want to know is how do you get product market fit? How are you going to aggregate a world-class team? And just how are you going to get going?
So you've mentioned the team a couple of times. What if the team's inexperienced?
Inexperience means a lot of different things. The beauty of today's market and, with the web and the internet is, if you've been in this thing for 5 years, you're kind of a wily veteran. The internet and the web, web services are relatively young. The shared economy is very young. Internet marketplaces are fairly new as well. So I don't think we worry about inexperience as much as we worry about the amalgamation of a team completely combined. So look, if you are a technical founder and a technical visionary, have a partnership with somebody else who, is able to do some things on the business side. If you're just come out of business school, make sure that you've got technical depth on your team. And, make that technical depth part of a team. I think, we talked to an entrepreneurial team this week. We have not yet funded, out of hundreds of businesses that we funded, we have not yet funded a business that had outsourced tech. We believe that tech is so important and product so important, it's got to be integral to your marketing, your sales, and your company. So, don't come and say, we're very smart MBA students, but we got this, outsourced tech group in Argentina that they're not part of us, but we're paying them to build this.
So let's come back to DraftKings.
Sure.
3 guys.
Yep.
Good technical expertise or experience out of Vistaprint.
Great customer acquisition expertise too.
But hadn't run a company.
Never.
What did you see in them?
We saw, funny enough, this gets back to your question of, team and experience. They loved fantasy sports. The 2 things that they were absolutely passionate around were fantasy sports, and here's how you do customer acquisition, and here's how you can do this in a mobile environment. And, you could have said, oh, well, you need a more experienced team. Experience in what? These guys were the Vistaprint user acquisition, customer acquisition team. There's nobody better in the world to basically aggregate customers, and they were maniacally fanatical around fantasy sports. We took a bet. It was a big bet. It was not only a big bet on the team, it was a big bet on the regulatory space. We seeded the company ourselves. We couldn't get a single other venture capital firm to do the Series A, so we did the Series A ourselves. And now, everybody's falling all over themselves trying to invest in the company. We get probably 5-10 calls from VCs, hedge funds, mutual funds, very wealthy individuals that want to tell us how much they love it.
So you wrote a check, but what else do you think was critical that you added as an investor besides the money?
Look, I think venture capitalists often overestimate their value add. I think in this case, we made some really key introductions to Jason. We helped him get the Major League Baseball deal. We helped him get the deal with the Red Sox. We helped him get the NFL deal. We introduced him to some team members. We were a great amateur psychologist for Jason.
What do you mean by that?
I mean, the Series A round was super painful. Jason pitched, he would tell you, he pitched 40 people, and 40 people told him his baby was ugly. And he would come back, and we just keep telling him to go out there and pick and shovel his way to a Series A and keep his head down. And then I think, the best thing we can do is pattern match. And pattern matching is dangerous, but I think we just kept telling Jason that, look, if you have these unit economics and you can continue to have this progress around the product and the number of customers and the cohort data, you're going to make a big business. And we believed it, and he believed it, and the rest is history. And
by pattern matching, you mean that this team or this situation looks like another situation that you've been involved in or seen, and it's been successful.
Successful or not successful. I mean, I think, we have data from, 200 to 500, kind of portfolio companies, depending on how you look at it. And I think we can say, this worked here, this didn't work. This team did this was the result. We can point to IPOs, we can point to companies that hit the wall 1 million miles an hour. There is no perfect pattern matching, but I think, that there is some wisdom to be gained by all these different, experiences. And the best thing we can do is pass that wisdom along.
So oftentimes the elephant in the room, particularly I think when dealing with a less experienced management team, is that the VC might come in and pretty soon they'll be replaced. How do you deal with that fear, whether it's articulated to you or it's left unsaid?
It's funny, just this morning I had a founder that came in and he said, well, do you remember when you fired me in 2008 and took me off the field? And I thought about it and I said, yeah, I do remember that. And he's like, thank God you did that. It was like, the company's Bit9. It's going to be one of the most successful companies in the Boston area. Will be an IPO next year. And he said, I was struggling so much with it at that time. He's like, even though I seemed angry, he's like, I was so ready to be, removed. And I thought about it, and he's like, do you have any lessons for me from that? And I thought about it, and I realized that's been 7 years ago, and the number of founders that we've moved out and replaced with other people, I can count on one hand. So it's like less than one a year. I don't want to run your business. I'm not set up for that. I sit on 14 different boards, and I'm watching 30 different companies, and I'm running a fund with responsibility for limited partners money. What I want to do, I want to be an accomplice to you in helping you go out and create a really valuable company. And at the end of the day, I feel like an invited guest. I'm going to give you my opinion. I'm always going to give it to you straight. It's up to you whether you take it or not.
All right, let's shift gears a little bit if we can. And so you've decided that you're interested in making an investment.
Okay.
But then we get to the money and we get to valuation. And I don't know how many times, Jeff, I've heard it said that valuation is more art than science.
That is true.
Is that true? So explain the artistic process to us.
So at the earliest of stages, everybody's just trying to get to what is a workable taxonomy. And what I mean by that is, what's the right amount of money for a company to take in at a certain point in time? And how much money does it take to get to the next value inflection milestone? And, let's say that it's $3 million. And then it's like, okay, so what's the right ownership for a venture capital firm to take this very seriously and make this part of, kind of their investment portfolio where they're going to put real work into it and a shoulder into it? What's the right amount for a founding team? What's the right amount for an employee stock option pool? And then you just kind of start to move levers and try to figure out what is a workable taxonomy where, everybody should feel a little bit bad about a negotiation. I should feel like I didn't get enough. A founder should feel like they didn't get enough. Everybody should feel like, there was just a little bit that wasn't there. But at the end of the day, it doesn't matter. What you want to build is a very big pie where, whether I have 10 or 12 or 15 or 20%, I do great. And the founders, whether they have 20 or 25 or 30%, they do great. And, the employees at the end of the day are going to make this. And I think that's the most important thing is make sure that you're putting enough employee stock option pool. But valuation's tough. And, I'm not valuing anything on, the metrics. Because we're investing so early. I mean, the only thing that's driving valuation in the early stages is supply and demand. How many other people are going to pay a certain price, and how does that work out? And, you see a lot of things right now in today's market. It's as frothy and as stratospheric from a valuation perspective as we've ever seen. And we still believe that price and price discipline matters in Series A investments, and we stick to our guns around that.
And so is it take it or leave it, or do you leave yourself a little room?
No, it's never take it or leave it. We just don't believe in some of this bullshit. We don't put take it or leave it deals on the table. We don't put exploding term sheets. Some VCs are like, here, you have 24 hours to make a decision.
Or sometimes 48. They're
or 48.
Good guys.
I never put a time frame. I'm like, here. And I will not take money from anybody that hasn't done at least 5 references on me. I mean, I won't give somebody money and allow them to take money from me unless they've done 5 references. So to me, it's one of these things where take as long as you want to decide that we're the right partner. And if somebody wants to take my term sheet and then go get a higher kind of valuation because Jeff Fagnon and FK are decided that it's worth it, somebody I want to be in business with anyway.
So if there's a deal and you're, say, going to make a $5 million investment, and you realistically think, or you think that there's a good chance that it's going to result in $50 million or a 10x in 3 years or 5 years, is that a deal you're going to do?
No. I mean, I think the math around what we do is we are the top of this asset class pyramid. The limited partners who are endowments, foundations, family office, pension funds, they want us to be the riskiest part of their asset allocation. And for us, I mean, what that means is we want companies that can be really big outliers. At the end of the day, the outliers are really the things that matter in our business. So, is 5 to 50, something we would do? Yeah, it's a 10x. It's not what moves the meter. I mean, what moves the meter to us is fund returners. We're investing a $250 million fund. How do we have one company that produces enough return to basically return that fund? And what we try to do is have 2 or 3 of those in any fund that we're in.
So what are some of the key metrics that you look for when evaluating a business that sometimes comes as a surprise to management?
I think the things that we think about a lot, especially like in the earliest stages, aren't really revenue based. We care about customer learnings. We care a lot about customer engagement. So I had a company in here recently that was telling me about all their MRR growth with monthly recurring revenue. And they're like, look at this trend. And I was like, how often does a customer use your product? And they couldn't tell me. And I was like, look, to me, what I want to know is, does a customer use it daily? Do they use it weekly? How many hours are they spending on it? What exactly are they doing with it? We care about those things a lot. I think that in today's society, it's not even somebody paying dollars that's the shortest scarcity. It's, do you have their engagement?
And so again, back to DraftKings, when you were looking at that, I suspect you wanted to get comfortable with whether this was online.
3 hours a day.
Yeah.
People were spending 3 hours a day in the app.
Yeah.
About the sickest engagement metric you could get.
Yeah. Okay. So, Jeff, you've been a partner at Atlas since for about 10 years or so. How has your investment approach evolved over that time? And I know you've been investing longer than that.
Yeah,
So,
sure.
So how is your investment approach?
The biggest change is that companies today can get going on really small amounts of capital. You know, when I first started in venture in 1999, it was you needed a $5 to $10 million investment to bring product to market. You can do it on 1/10 of that, 500K to $1 million. And to me, that's why this democratization of early stage capital is so damn good for society, is we've created a whole new era of a lot more entrepreneurs and a lot more innovation. And that's a great thing. And I don't care if you get funding from us, you get funding from Techstars, you get funding from your uncle, funding from the government, funding from other angels. To me, it's just like the fact that more people are willing to write checks because companies can now get to initial proof of concept, get to market, get customers on smaller capital. It's great. It's great for society. It's great for all of us. It's great for my business. So I think we look at it as that's the biggest change.
And how about crowdfunding? How has that affected democratization and otherwise?
Yeah, it's a great question. I mean, crowdfunding, there's one side of it, which is Kickstarter's crowdfunding. Kickstarter is an amazing phenom, which allows companies to get funding, to get marketing, pre-orders, all of this, all the way to AngelList, which is the reference, marketplace for early stage innovation to meet, accredited investors. And to me, it's really just software eating the world. AngelList is replicating exactly what happens offline, online, but it's a software experience.
And so last question, how about looking ahead? How is your firm, your industry, what you do every day, how is that going to be different 5 years from now, 10 years from now?
God, it's a great question. I mean, I think that at the end of the day, venture capitalists are intermediaries. We sit between somebody that wants to invest in innovation at an asset class, and we sit between entrepreneurs that need capital. Software is going to disrupt this intermediate market. It's done it with travel agents, done it with financial advisors, name the industry, it's done it. It's going to do it here. And it's a good thing. And to me, that what that means is there are going to be fewer venture capitalists, which is a good thing. There'll probably be more angel investors, which is a good thing. And there's going to be a lot more innovation in entrepreneurs, which is a good thing. And so from our perspective, we think about entrepreneurs as the nucleus of every single thing we do. It's a great time to be an entrepreneur. And, for us, we're in the service business. We're not the rock stars. We're just trying to sit here and support from a service orientation the people that are really taking these big risks. And for us, it means we have to think about all the value add. It means we have to think about our capital and how we're deploying our capital. And then think about, what we stand for as a brand. The best entrepreneurs are going to have a lot of choices. And for me, I'm hoping that even people that are kind of watching this, they think about being an entrepreneur. They think about, what they want from a partner, whether it's on the funding source or other, and that they look me up.
Well, Jeff, I want to, on that note, I think that's a good note to stop. And so I want to thank you. And I know my students at Isenberg want to thank you for your thoughts and much appreciated.
My pleasure.
Good. Thanks.